Welcome to the Deep Dive, your go-to for cutting through the noise, getting straight to the insights that matter.
Glad to be here.
Today, we're jumping into CNX Resources' second quarter 2025 earnings call.
Yep. Our mission today is really to unpack the key takeaways. We'll look at their financials, sure, but also their strategy, what's next.
And what it means for you listening.
Exactly. We'll be digging into what the management team's CEO Nick Dullius, President and CFO Alan Shepard, and COO Navnet Bell had to say. Or rather, what their materials showed, since the call itself was all Q&A.
Right, good point. Okay, so let's start with that snapshot. Q2 performance. You mentioned the call was Q&A, so where are we getting this from?
Yeah, so they put out updated presentations and detailed earnings data alongside the call. That's our source material here.
Got it. So what's the headline from that data?
Well, the big thing seems to be really strong operational execution. One immediate highlight was definitely an outperformance in production for the quarter.
Okay, outperformance. What drove that?
They pointed to a combination of things, really. Signaled efficiency gains, strong well performance, too. It paints a picture of things running pretty smoothly on the ground.
That production beat is interesting. Can we dig into that a bit more? What specifically pushed it higher in Q2?
Sure. It looks like it wasn't just one silver bullet, but more like four things coming together.
Yep.
First, they had really strong performance from new wells, specifically the Apex Marcellus and those Utica wells we'll talk more about. They really delivered.
Right.
Second, just excellent operational execution. They actually managed to pull production forward, get more done faster than planned.
Efficiency.
Exactly. Third, they got some unexpected efficiency gains on their existing base production, so older wells doing better than forecast. And fourth, just better uptime, fewer interruptions, things running more consistently. So, all four lined up for that positive surprise.
That makes sense. Okay, so let's move into where it gets, really interesting, the strategic stuff.
Yeah, the deep dive part.
Let's start with something that's had a lot of buzz, the 45Z tax credit.
Yes, 45Z. It's definitely a hot topic.
So remind us, what's the core idea here?
Right. So this credit, it's all about giving companies an incentive to capture waste gas, specifically methane, from places like coal mines.
Stuff that would otherwise just vent.
Pretty much. And then, turn it into a marketable product you can put in a pipeline, basically turning a problem into revenue.
Okay, makes sense. So when does CNX actually see the cash from this? It's not immediate, right?
No, exactly. The first year they can actually claim these credits is 2025. But the cash itself, the potential cash realization, they're projecting maybe a $30 million annual run rate.
$30 million a year, okay.
Yeah, but that wouldn't actually materialize until 2026. It's tied to when they file their 2025 tax return.
Got it. So a bit of a lag, but a significant number once it hits.
Definitely. And it's, a pretty solid, predictable stream compared to just gas prices.
What about how long this program lasts? Is this a short-term thing?
Well, right now, it's legislated through 2029, so a decent runway.
Okay.
And there's always potential for it to be extended, especially with the focus on methane these days. We'll see.
And a big question people have, how does this play with other programs? Can you stack these credits?
The stacking question. Yeah, that's key. It gets a little murky because the final rules aren't fully out yet.
Right. But
the initial guidance CNX gave suggests, yes, it is stackable with the Pennsylvania AEC Tier 1 credit.
Okay.
But it's not like one for one. The volumes don't perfectly overlap. They described it as more of a blend. So still waiting on final clarity, but potentially stackable.
Interesting. So multiple ways to get value from the same gas, potentially.
That seems to be the idea, yes.
Okay, let's shift gears then. Moving from new credits to the core E&P business. What about activity levels and capital allocation, especially in their main production business?
Right, the ENTP side.
Right.
Well, management was pretty clear here. They don't have plans right now to increase volumes.
Oh, interesting. Why is that?
Mostly because natural gas storage levels are just so high. They're heading towards, 4 TCF, which is a lot of gas and storage.
Right. Signals an oversupply, puts pressure on prices.
Exactly. So they're basically sticking to the plan they laid out at the start of the year. No major shifts in activity level for now.
So a cautious approach on volume. What does that mean for capital efficiency then? Looking ahead to, say, 2026?
Yeah, they gave some guidance there. For 2026, they're targeting a capital efficiency ratio of around 85 cents per McPhee per million cubic feet equivalent.
85 cents. How do they get there?
It's based on their earlier guidance, producing about 580 BCF equivalent on roughly $500 million in CapEx. Do the math, it gets you in that mid-80s range.
Okay.
And they basically said, look, that mid-80s number, That's the right way to think about our capital efficiency going forward. The focus is always on optimizing for free cash flow per share.
Right, not just chasing production numbers, discipline.
Discipline is the word, yeah. Squeezing value out of every dollar spent.
Okay, so how does that focus play out in their actual drilling and completion activity? Where'd the money go in the first half?
Well, the CapEx was definitely front half weighted in 2025, meaning, most of the spending happened earlier in the year.
Okay.
And same thing for their turn-in lines or TILs, the new wells they brought online. The bulk of those also started producing back in the first quarter.
So wait, if most wells came online early, does that mean production actually drops off sequentially in Q3 and Q4?
That's exactly right. You should expect production to be lower in Q3 and Q4.
Okay. It's planned then, not a surprise dip.
Totally planned. It'll stay lower until the next batch of wells, the next TILs, come online, and they're planning that for late Q4.
Right. And CapEx follows that pattern too.
Yep, same trajectory. Lighter spending in Q3, then it picks back up in Q4 as they gear up for activity, preparing for winter 2026 production.
So it sounds like basically a pause in completions during Q3, then things ramp up again in the fall.
That's precisely the way to think about it. They'll keep the drilling rig running, that one rig program continues, but the actual completions, there'll be a lull before they get busy again for those December wells.
Got it. Very managed cadence. Now, let's talk about something generating excitement. The Utica play. What's the story there?
Yeah, the Utica. The team, Navnet Bell's team, they're really pushing hard on efficiency. They're improving operations, cutting costs.
Oh, they got going.
Remarkably well, actually. They're already operating below their initial cost targets.
Oh, wow. Below target already.
Yeah, which says a lot about their execution. They're not just hitting goals, they're beating them and still looking for ways to trim costs further.
Okay, costs are good. What about the wells themselves? Are they performing?
Absolutely. All the Utica wells are performing within expectations. And actually, the latest ones, the Q2 TILs, came in slightly above expectations.
Slightly above. That's definitely positive.
Yeah, management sounds very encouraged. It suggests, it's a predictable, high-quality asset shaping up.
How does this stack up against their established Marcellus operations? That's been their core for so long.
That's the key comparison, right? Management actually stated that these Utica wells, with the current cost structure they've achieved, are competitive with even the best Marcellus wells in Southwest PA.
Really? Competitive with the best Marcellus. That's a big statement.
It is. It implies they see a long runway here, repeatable results. They're intentionally giving Navnet Bell's team the space to keep driving down those costs.
So they'll balance both. Keep drilling Marcellus, but also expand Utica.
Exactly. It's not either. They'll keep developing the core Marcellus, but also strategically expand in this newer CPA area where Utica sits. Project selection comes down to full cycle IRR. The best return wins, regardless of the play.
Makes sense. Okay, let's pivot to the final big theme. In-basin demand, AI, and remediated mine gas, RMG. This seems huge for their future story.
Absolutely. It connects a lot of threads. First off, their revised guidance for free cash flow just from environmental attributes is now $65 million.
$65 million. Wow.
Yeah.
What underpins that?
That's based on current market prices for what's called the PA1 strip Pennsylvania Tier 1 renewable energy credits. They're trading, mid-20s per megawatt hour right now. So it's a real market.
And where does AI fit into this? We hear so much about data centers needing power.
Right. So RMG, that remediated mine gas we talked about with 45Z, is being positioned as a key sustainable energy solution for these new data centers.
Oh, so?
Well, think about it. Big tech companies are pushing hard for zero carbon operations. Using RMG, which literally cleans up methane from old mines, gives them a really credible story for achieving that. It's a sustainable fuel source.
So CNX is talking to potential data center customers.
Discussion's definitely ongoing. They sound pretty optimistic about attracting more demand from this voluntary market. Companies choosing this route for sustainability, not just meeting regulations.
Okay, this sounds bullish long-term for gas demand in the region.
Yeah.
But what about near-term? How does it affect their hedging? And is this AI demand a sure thing?
Yeah, long-term, absolutely bullish for Appalachian gas demand, especially because it's in-basin demand, bypassing some of those old pipeline bottlenecks.
Right.
But management is still, a bit wait and see on which specific data center projects get built and when. They know they have the gas and can deliver it. But their short-term hedging, that's still driven by balance sheet needs and capital discipline, not really speculating on when that AI demand fully kicks in.
So caution on the timing.
Exactly. The sustainability need for tech is real. RMG is a great solution, but the exact timing and scale of those projects is the uncertainty.
And for the RMG itself, where does the value get realized? Is it the credits?
Yeah.
The gas? Both?
They'll sell it to whoever pays the most, basically. Right now, the highest value seems to be in the renewable energy credit market, those RPS programs.
Okay.
But RMG is finite, right? There's only so much. So they expect the voluntary market companies buying it for their own green goals could eventually pay just as much, maybe more, than the regulated credit markets.
And back to stacking, can you stack the value streams here? Like get 45Z and sell credits and get value for the gas?
Generally, no. You can usually stack maybe one or two things, like 45Z and a state REC maybe, but not everything on top of everything else. It usually becomes competing ways to get value, not additive layers beyond a certain point.
Okay. Complex, but definitely promising.
Yeah.
What's the trigger then? What unlocks this?
Yeah, it is complex. Management basically said the first really clear signal will be when we see an actual announced deal, a data center formally committing to take power fueled by Appalachian gas, potentially using RMG.
That first big contract.
Exactly. Until that happens, they're hesitant to lock into long-term deals. They want to see how the market shapes up first, capture the best value. It's patient.
Okay, so pulling this all together, what does it mean for someone tracking the energy space, or CNX specifically?
Well, connecting the dots, CNX is clearly playing a long game here. They're managing the current market, yes, focusing on efficiency.
Like with the Utica costs and capital discipline.
Right. But they're also building these new foundations. The 45Z credit is a big one, providing that baseline cash flow. And the Utica play looks like a solid organic growth engine.
And it really seems like they're positioning for this big shift towards localized, sustainable energy demand driven by tech and AI in their backyard.
That's the key takeaway, I think. They see this potential reindustrialization happening in Appalachia, driven by data centers needing massive amounts of power, preferably low carbon power.
Which RMG helps provide.
Precisely. So while they're cautious short-term on predicting the market, the underlying thesis is strong. Local demand for their gas, potentially at a premium for its environmental attributes, could be a major long-term tailwind.
All right, let's transition to our favorite segment. Time to put on our hypothetical hedge fund hats. Remember, everyone, this is absolutely not financial advice.
Definitely not advice. We're just kicking around some ideas based purely on what we discussed today. Outrageous but plausible trade concepts.
Exactly. So based on CNX's story, the caution, the optimism, Utica 45Z, AI, what's an outrageous but plausible idea?
Okay, here's one to chew on. Given that cautious but ultimately bullish tone on AI demand, the Utica success, that 45Z cash flow coming.
Yeah.
How about thinking about a long position in CNX, but structured maybe as a long-dated, out-of-the-money call option spread?
Okay, break that down. Long-dated OTM call spread.
Right. So long-dated means you're giving it time to play out, maybe a year or more. Out of the money means you're betting the stock price needs to move up significantly from where it is today to be profitable. And the spread part helps define and limit your maximum potential loss and gain. It's a defined risk bet on significant upside.
Okay, so what makes it outrageous?
The outrageous part is you're explicitly timing your bet, or rather, basing your bet, on a future event that hasn't happened yet and isn't guaranteed. That first big public data center deal in Appalachia using local gas or RMG.
The catalyst management talked about.
Exactly. You're betting on that specific signal unlocking value that the market isn't fully pricing in today.
And the plausible part, why might this work?
Well, the plausibility comes from everything else CNX is doing. They are drilling successful, low-cost Utica wells. They are about to get $30 million a year baseline cash flow from 45Z starting next year, which de-risks things. They do have this unique RMG resource that tech companies genuinely need for their ESG goals.
Right.
So the pieces are there. The market seems hesitant on the timing of the AI demand boost, creating the potential opportunity. If or when that first big data center deal hits, it could re-rate the stock. This options strategy is a way to potentially capture that upside with less capital upfront than buying stock and with the known maximum risk. It's a conviction play on that Appalachian reindustrialization story.
Interesting. A defined bet on a specific future catalyst underpinned by current execution. definitely fits the bill.
Just thinking out loud, of course.
Of course. Wow, what a deep dive that was into CNX Resources Q2 2025. We went from tax credits and drilling plans all the way to AI data centers and speculative trade ideas.
We covered a lot of ground. And just to reiterate one last time, everything discussed today is for informational purposes only. It is definitely not financial advice. Please do your own research.
Couldn't agree more. Thanks for tuning into the deep dive. If anything sparked your interest, definitely dig deeper yourself. Until next time, stay informed, stay curious.